Money decisions shape our lives far more than we realize. A single investing choice you make today can echo years into the future. Some people don't discover this until it's too late, but you're here now, and that already puts you ahead. Because today, we're exploring a question that has sparked debates in financial circles, created confusion among new investors, and even surprised people who thought they already understood the markets. The question is simple, but the answer is not. Which strategy works best? Lump sum investing or dollar cost averaging? At first glance, it feels like a question with an obvious answer. Either invest everything at once or spread it out. Easy, right? But this choice has layers. Psychological layers, mathematical layers, emotional layers. And depending on who you are, the best strategy might not match the one that performs best on paper. That's where the story gets interesting, and that's exactly why you'll want to stay until the very end. By the time we finish, you might rethink your entire approach to investing. And when that happens, share your thoughts in the comments. Seriously, your perspective could help someone who's just starting. Let's begin with what investors call lump sum investing. It's exactly what it sounds like, taking a large amount of money and putting it into the market all at once. No hesitation, no dividing it up. Whether the amount is $1,000, $10,000, or even more, the idea is to get the money working immediately. There is a powerful reason why many financial studies prefer lump sum investing. The market, historically, rises more often than it falls. Over the long term, the trend is upward. That means the earlier your money is in, the more it can grow through compounding. If you think about every day your money sits on the sidelines, that's a day it's not working for you. But this brings up a real fear. What if the moment you invest just happens to be the wrong moment? What if the market drops right after you put everything in? Suddenly, your money shrinks, and you're stuck watching your account balance fall. That worry, even if the odds are low, can stop people from investing altogether. This is where dollar cost averaging, also known as DCA, enters the conversation. Instead of investing everything at once, you spread your money across multiple investments over time. Maybe you invest monthly, maybe weekly. Maybe you break a large amount into smaller pieces. DCA smooths out the highs and lows of the market. If prices fall, you get to buy more shares. If prices rise, you still participate but avoid the risk of going all in at the peak. DCA isn't just a strategy. It's a psychological cushion. It reduces fear. It reduces regret. It helps people stay invested because the risk feels more manageable. For many beginners, this emotional comfort is just as important as the mathematical results. So which strategy actually works best? Here's where things get interesting. On paper, lump sum investing comes out ahead most of the time. Not every time, but most of the time. Markets rise more often than they fall, and statistically, the earlier your money enters the market, the more it grows. But the story is very different when emotions enter the picture. Investing isn't just about charts and percentages, it's about confidence. It's about staying consistent during the ups and downs. If a strategy makes you so nervous that you stop investing or pull out your money too early, it doesn't matter how optimal it looks in a spreadsheet. This is why many people prefer DCA, not because it always wins mathematically, but because it helps them stick to the plan. Now here's a question for you. Which matters more? The strategy that performs better statistically, or the strategy you're most likely to follow consistently? Think about that for a moment and drop your answer in the comments. Your response might help someone who's struggling to choose. Let's look at a real-life example. Imagine two investors. One invests $12,000 all at once at the beginning of the year. The other invests $1,000 each month. If the market rises steadily, the lump sum investor wins easily. Their money had more time to grow. But if the market is rocky, falling early in the year and rising later, the DCA investor might end up with more shares at lower prices. The interesting part is that no one knows the future. If markets always rose in perfect order, investing would be simple. But they don't. They jump, they fall, they panic, they recover. You can't predict the timing, and that uncertainty keeps the debate alive. At this point, let me pause and ask you something. What do you personally fear more? Missing out on gains because you waited too long to invest, or losing money immediately because you invested everything at once? This says a lot about which strategy fits you best. Share your answer below. I really want to know which fear is stronger for you. There's another twist to this story. Even though lump sum investing usually wins statistically, most people don't invest that way. Not because they're wrong, but because real life rarely hands us a big pile of money at once. For most people, investing naturally happens through DCA. Every paycheck, every month, a little money gets invested. It's automatic. It's consistent. It builds a habit. This is why DCA is considered one of the easiest ways to start investing. It removes the pressure of choosing the perfect moment. You invest no matter what's happening in the market, and over time, your average cost balances out. Many long-term investors swear by this approach because it turns investing into a routine instead of a stressful decision. Now here's something to think about. If someone gave you $20,000 today and told you to invest it, what would you do? Would you invest it immediately, or would you spread it out? Leave your answer in the comments and explain why. You might discover your own investing personality through that answer. We also need to talk about something many people overlook: opportunity cost. When money sits in a bank account waiting to be invested, it's not growing. Inflation slowly eats away at its value. This is one reason experts often argue for lump sum investing. They don't want money sitting idle when it could be working. But emotional comfort matters too. If spreading out your investments helps you sleep better at night, that peace of mind has real value. The best strategy is the one you actually follow, not the one you abandon because it makes you nervous. Before we continue, if you're finding this helpful, make sure to like, subscribe, and share this video with someone who's trying to learn about investing. And tell me in the comments, have you ever made an investing decision you regretted? What happened? Your story might help someone avoid the same mistake. Now let's explore the deeper reason both strategies continue to exist. Humans don't like uncertainty. When markets fall, it feels like losing real money, even if it's only temporary. That emotional reaction can push people to make bad decisions. Dollar cost averaging softens that blow. It gives people time to adjust to the market's rhythm. On the other hand, lump sum investing taps into something powerful too: boldness. It reflects a willingness to trust the long-term growth of the market. It's a strategy of confidence, of belief in the long-term upward trend of human progress, innovation, and economic growth. So which strategy is truly better? Here's the truth. Both work if you stick with them long enough. Neither strategy can save you if you panic and sell at the wrong time. Neither strategy guarantees profits in the short term. But both strategies, applied consistently over many years, have helped countless people build real wealth. The real question is not which strategy is better, but which strategy fits your personality, your emotions, and your goals. Are you someone who needs smooth consistency, or someone who feels comfortable making bold moves for long-term rewards? Whatever your answer is, you're not wrong. Now that you've absorbed the story of lump sum investing versus dollar cost averaging, let me ask you one final question. If you had to choose one strategy to follow for the next 5 years, which one would you choose, and why? Leave your answer in the comments. Your reasoning might inspire someone else watching this. And if you enjoyed this deep dive and want more helpful, simple investing content, make sure to like, subscribe, and share this video. Your support truly helps this community grow and helps more people learn how to take control of their financial future. Which strategy will you choose, and how will it shape your journey from here? The next step is yours.